Much to talk about here, a lot of news flow stateside, but I think we're really marching towards the end of the quarter with rate cut expectations running high. Bill, your cut call is particularly high. Do you really think the Fed can cut 100 basis points this year?
Yeah, hi Dan, it's very nice to be with you. I think it's higher than the market consensus right now, but as we've seen recently, this consensus can move by quite a big margin from one meeting to the next. And I think by the time we get to the start of the cutting cycle and central banks, especially the Fed, have sufficient confidence that the inflation outlook is benign enough for them to be cutting, I don't think 4 cuts this calendar year will look that excessive. I think it will look very reasonable by then.
But they're in no rush to cut rates, right? And the data has still been running hot. So what is it specifically that makes you say they will need to cut by 100 basis points, particularly after the commentary that we've seen in the last 24 hours? You're going to have to change your call, I think, Bill.
That's right. There's no rush right now, but you have to keep in mind that the start of year data are always particularly noisy. And in the recent meeting, what could have easily happened was either these dots moving significantly or the language coming during the press conference by Jay Powell being sufficiently more hawkish. Instead, what we got was unchanged median dot for this year, and Jay Powell telling us, start of year data are particularly noisy, there's seasonality in them, but we're looking at the trend and we generally like what we see. So between now and the June meeting, things can move quite a bit. So I don't think our call will change. I think the consensus will.
Okay, let's watch that space. At the same time, Bill, we see central banks in Europe like the ECB front-running the Fed here and cutting rates. What do you think this means broadly for the ECB and other major European central banks here, particularly if you're calling for a 100 basis point cut for the Fed? How is the ECB likely to respond?
So I think the ECB will mirror that amount of cutting during this year. And to be honest, they have every reason to be doing it. The inflation outlook is more benign in Euro area than in the US. And the growth outturn has been much worse. We've basically seen no growth for a good year and a half by now. I would be a little bit careful in extrapolating too much from what the S&P has been doing because, inflation is good 1%. Here, much more contained than elsewhere. But still, when you get a G10 central bank being confident enough to start cutting already at the March meeting, maybe it's giving you a sign about where things are going. They might not go there that fast, but between now and June, I certainly expect the ECB to be moving that way as well.
Okay, fascinating. And this is a two-pronged question here, Bill, because we're rapidly running out of time. But first of all, we're on yen intervention watch in Japan. Right now, we've seen just verbal intervention and jawboning. Will we see actual FX arbitration taking place? And then the second question is, as we close out the first quarter, what's the investment strategy that you're taking into Q2 and why?
So the answer on the yen is that we cannot know this for sure, but it does look quite likely. We know the Japanese authorities are sensitive on additional depreciation, and we know that the central bank will give that leeway to the Ministry of Finance to sort of intervene on the FX market before they come back and do additional rate hikes that they will be doing in a gradual way. So no certitude here, but I think a pretty high likelihood. The question about investment strategies, I guess, takes us to a different conversation here. In the current environment, we do think you still have some gains to make by investing in bonds that offer you pretty attractive yields, but these yields are unlikely to be there forever. As we said before, rates will be cut during the second half of the year. So an additional, overweight exposure on fixed income assets, especially on good quality sovereign or corporate debt, looks like a good strategy. Otherwise, we have our equity exposure pretty close to benchmark. We've had a very good run and we've enjoyed it. And given the yield advantage and the growth advantage that the US offers versus its peers, I think an extra exposure to the US dollar against other G10 currencies looks favorable in this context.